Friends, today I'm going to talk on taxation of shares and derivative transaction under income tax. So I'm talking on behalf of Isaca, President of Isaca chapter. We are regularly conducting a Zoom workshop on every Friday at 6:30 p.m. on different subjects. And after the seminar is over, many presentations which with the permission of the author, the speaker, we put it in a blog. Blog address is Nitin Pathak blogspot.com. We are a part of Isaca chapter all over India, all over the world. Isaca chapter is running. Basically, they are providing. They are providing. This is an NGO which is recognized all over the world, having CISA, CSAM, CGIT in the field of information system, and there are a lot of COMMDITY standard and other standard developed by them, which is available on their blog, and there are many books and blogs are available on this. So to join with Isaca chapter, you are benefited immensely in terms of treasure of knowledge and how to enhance the information system in your organization, including the security. Please call on us or drop an email at nitin@gmail.com. We will like to support you. Here I am going to talk on taxation of shares and derivative transaction under income tax. These are my personal view. We are not responsible for the opinion given by us, but we have taken absolute care to give the opinion on the basis of facts related to that. What I'm going to cover right now is how to account for shares, how to account for mutual fund, how to account for PMS, how to account for intraday transaction, how to account for future and option, derivative, commodity transactions. These are mostly covered. And what are the tax impact? This basic is the context in which this is developed. This is one of the most likely encyclopedia in the field of this. एक second, huh? What is short-term capital asset? What do you mean by short-term capital? Short-term capital asset is liable for short-term gain. Long-term asset is liable for long-term gain. And long-term asset is liable for long-term gain. There are different type of short-term capital asset. Core capital asset, there are different period which we have covered. Cost of acquisition is considered for, say for example, consider for valuing the capital gain. You have to have the acquisition cost, less expenses incurred for selling cost of consideration, less selling expenses, minus cost of acquisition, minus cost of improvement. This is equal to capital gain. There will be indexing under an 11A, 1112, which allows for a different rate, special provision for NRI. Section 45, 47 consider what is the period of asset, what is the consideration. 115 QA is regarding buyback of shares. What is the capital asset and when it will be considered as capital asset, cost stock in trade, and how one should decide and how government will, how income tax department would take care of it. There are different rate exemption in case of transfer and valuation concept and dim valuation. These are the points which we have covered. I'll go stepwise. I will cover easier part first, then I've taken a tougher task. Derivative. What do you mean by derivative? The future and options are considered as derivative. F&O is for Nifty, for BSE index, and there would be a date. There would be also available for core shares. Commodity transaction. A commodity transaction is done for purpose of hedging by the businessman, and many people are take a risk at a price and at a premium they are receiving or paying. This is called commodity transaction. For the purpose of that, commodity transaction which are entered through stock exchange would be considered as a business income, not as speculative income. Shares PMS shares PMS investment can be either as investment or stock in trade. What do you mean investment? In investment, your purpose is not to earn a profit, but to have a long-term increment in profit, in your value. Stock, generally you are selling and buying, buying and selling for a price, you are improving upon it. How to determine whether your folio is a stock in trade or investment? Circular 6 by 216, which is an exhaustive indicator, whether your share, PMS, mutual fund, uh, your transaction is an investment or a stock in trade, would depend on the character of things. Suppose I invested in 100 crore in Reliance. I borrow for that purpose of 80 crore. So it means my purpose is to earn money, and it would be always a stock in trade. Suppose I bought a Reliance, say, and I see in today, or say 10 years back. So naturally it is a investment. Number of transactions, many times you buy and sell, then it would be considered as buy and sell. And SEC is a choice to make on the basis of the above parameter which I discussed. And there are many more things, circular 2006 mentioned about it. And how you show in the books of account is also have an impact whether it is investment or stock in trade. Once you decide qua shares, you can decide the following Reliance share is my investment and the following are my stock in trade. And there are group of shares, particular investment, particular mutual fund, particular PMS. I have a 3 PMS set. I can say that 2 is a stock in trade and 1 is uh, investment. That is my choice. But once I make a choice, I need to stick into it. There is instruction 2016 where sales of a closely held company is always a current asset and not a stock in trade. And circular is always binding on department. Let me go 1 minute, take a second. Let me check whether recording is going to be done. No, recording is already going on, so no issue. A second. Pause the record. Yes, I'm coming back. And now I'm going to next. Circular is binding on department. So 2016 circular is binding on the department. Instruction is binding on SSE. That is a distinction between circular and instruction. Shares and derivative. In case of stock in trade, there will be a business profit. That is called, that is whatever business I earn, expenses incurred for that would be allowable as an expense. In capital asset, there will be long-term capital gain, short-term gain and dividend. So if I consider that the following sales I have got, following, suppose I bought a Reliance of 100 crore. And I said it is an investment. So if I borrowed that money for the purpose of investing in share market, and it will not be a deductible expense. The person I have kept for managing all this will not be available for expense. I bought it on the advice of somebody that it is a good share, you buy it for 5 years term. Even that will not be available if I take it as an investment. But whatever shares I have it would be a long-term gain, short-term gain or dividend. Dividend is now is a taxable income above rupees 5,000. Above 5,000 there will be a deduction of TDS from 1/4/2021. In long-term gain, what are the if it is 115, 11A, 112A, and there are a lot of exemption available in case of an investment. Shares gains, sell price, less expenses incurred to sell the shares. That is brokerage expenses, less stamp charges and other charges paid to this thing. But STT is not a deductible expenditure for capital expenditure, but for business it would be deductible expenditure. So STT is not a deductible expenditure. Many person doesn't know this. Purchase price equal to cost of purchase plus expenses incurred to purchase the asset, including STT. STT is not an expense for capital. For purchase, it will be added to a cost, but for sales, it will not be allowable selling expenses, which I have already discussed. Derivative transaction is for future option, in for commodity transaction. Derivative transaction entered through stock exchange would be considered as business profit, and it would be allowable to adjust against income from other source. Any loss which incurred, I can set off for 8 years. Any profit I can adjust against any other income except the salary income. Derivative income is equal to difference at the time of square off is profit or loss plus premium paid or received or any other income. Derivative income, suppose I bought a Nifty 100 at say 8,000 rupees, 8 multiplied, whatever the value of the transaction will not be considered. But as on the date it is squared off, the difference would be a purchase or sales, which would be a part of turnover. It would be a plus, then it would be a profit. Loss, it would be a loss. But for the purpose of computing the total value for the purpose of audit, it would be absolute figure, that is net figure. For turnover purpose of F&O, capital gains which are 44D is applicable to derivative transaction. Because it is a business profit derivative transaction, in 44 derivative, if your taxable income is below threshold limit, though your turnover is more than 5 crore, but if your taxable income is 1.5 lakh, you need not do audit. 44AD is applicable if your turnover is below 8%. If it is above 8% and less than 5 crore, more than 8 crore, more than 8% of the turnover, you need not do tax audit. But for the purpose of, suppose I have got a 2 crore turnover plus minus and I have a profit of rupees 20 lakh, then I have to show 20 lakh, not 8%. This 44AD is for the benefit of income tax, not for you. So whatever 44AD says, you don't need to keep a book account, but whatever profit you have to show it. Can HUF give a gift to its member? No, gift to members is considered as partial partition. Hence, it is not a valid partition. In the case of sale of share, it will be the income of HUF. On the partition, suppose I have a 100 crore share and we are 4 partners. I have divided 24 crore into demat account of each individual. When I sell the shares, as this is a partial partition, it would be added to the income of HUF, not in the hands of each individual. Though I have made a partition on paper and have added to my taxable income, though I have made a partition, it will not be considered as a partition for the purpose of income tax. Partial partition is not recognized. Can partnership purchase shares? Yes. Partner can purchase the shares in the name of individual, but from the funds of partnership firm, and shall be shown as investment in their books of account. Sale of shares, profit consideration can be invested under section 54, 54F, 54EC. 54F. Can I invest? Suppose I got a share of 100 crore Reliance, 100 crore I sell. I bought it for 10 crore. After indexation, it comes to 20 crore, 80 crore. Would I be entitled for 54F? Yes. Thus, long-term capacity asset would be available for investment under section 44F, but the condition is I should not have more than one house. If I've got 2 houses, I cannot buy it. If I have one house, still I can go it. After the sale of a share, if I buy another house out of consideration received by me, before 1 year of sale and after 2 years of sale or construction after 3 years, I'll be entitled for deduction under 54F. But it will not be available for the purpose of 54. 54 is applicable for residential building and 54 EC apply to land or building or both. So 54F yes, 54 no, 54 EC no. PMF can be either considered as business asset or investment. Qua PMS, one PMS I can say is an investment, other PMS I can say is an investment. But once I decided, I cannot change it frequently. In case of business asset, there will be a profit and loss account. The PMS, if I selected, I will be entitled for expenses incurred, say for example, 2% or 3% PMS management charges, expenses incurred, accounting, audit, every expenses I would be available, and the net profit would be liable for tax each year. In case of investment, it would be either long-term capital gain, short-term capital, or dividend. Long-term more than 1 year, more than 12 months. Short-term 12 or less than 12 months. All expenses will be ignored in the case of investment. In case of more than one PMS, I have a choice to do. Once I have chose, I cannot change it. Now, I'm asking you a question. Derivative transaction will be considered as business income. Derivative is equal to F&O, commodity derivative, and no delivery. But if it is traded through stock exchange, it would be available as it would be considered as business expenses. In commodity stock exchange, the rise or fall will result in a profit or loss, or premium received or paid will form a part of resulting gain, and it would be considered as business income. Form number 26 is of a portal. Sooner not than later, they would show your intraday transaction, your F&O transaction, your sale of transaction of shares, sale of debentures, sale of shares, everything they would say, and they would also show the profit out of that. So services would give you an information whether you've taken this into consideration or not. Further, the broker gives annual statement showing short-term gain, long-term gain, dividend, F&O profit, intraday transaction. Thus, it is easy to compile and file a return. The above figure, suppose I have made an F&O transaction of 2 crore, and I earned out of that 25%, say 50 lakh. But at the time of filing return, I have shown 8% under the pretext that I don't have to show the books of account, but that will be cross-checked by the artificial intelligence software of IT, by the income tax department, and you may give a notice, and sooner it may be auto-populated also. Once you give a buyback of shares, it would be shown under the exempt income, and DDT would be payable on that. Whether it is buyback is a quoted share or non-quoted share, in both the cases, it will be DDT would be applicable. Intraday transaction is always without delivery because delivery happens next day. Hence, it will be a speculative profit. The business lot of a derivative transaction will be available for set off against other business income as well as income from other sources. In case of a consideration of mutual fund, the new allotment of mutual fund will be considered as a period as well as the cost for the purpose of carried forward of the scheme. Suppose unit 64 is closed and now they have issued unit 2000. So for the purpose of calculation of my long-term capital gain, the period would be the date on which I purchase unit 64, and the cost would be same. Unit allotted would be new one, period would be old one, and the cost would be old one. Clear in the case of consolidation of mutual fund, the period as well as the cost of the previous scheme would be available. As in example, unit 64 we converted into unit 2000. Zero discount bond when redeemed will be considered as capital gain tax flat, no indexation, and long term for a period of would be available. It would be a short term capital gain. Deep discount bond, suppose I bought it for 1000 and after the period of 20 years I would be getting 1 lakh. Neither it would be a long term capital nor it is a short term gain. They would be considered on the basis of IIR or rate of return, every year there would be an added income as an interest income and would be liable for tax each year. Right shares. Right shares is always a short-term capital gain. Short-term capital. For example, the date on which I was entitled for a right share, say for example RIL, that would be the date and the value which I have to pay to right share will be considered as a cost. For example, rupees 220 right shares purchased by A from B, RIL 220 would be added to the income of purchased by A. So in the case of B, it will be a cost. It will be a capital gain tax. Suppose in the reverse case, B paid 220 and he paid 1257. So 457 would be considered as a cost price, and the date on which allotment would be made would be the date considered for the purpose of long-term or short-term gain. The date on which the allotment will be made, that will be considered. The right share, when the company make you entitled, that date would be the date on which you are entitled for. ESOP. Suppose A is an employee of ABCD Limited. He is given a right to buy 100 shares of ABCD. The date on which he is entitled for 1/1/2000, and 1/1/2000 he paid rupees 200. The market value is on that date would be 2000. 1800 would be considered as perquisite and would be added to his income. For the purpose of reckoning the date is 1/1/2000 and the value would be 200 he paid, 1800 he has to pay the perquisite. That will be considered as value of shares for him. 240 I will consider. In case of a buyback option, there would be a cancellation of shares. There won't be a capital gain in the case of company, but his capital would be reduced by the amount of which he made a buyback. Whether investment made in minor or spouse will be considered. In case of a minor or a spouse, it would be deemed that the owner of the owner of the minor, the minor's father or mother or spouse will be a deemed owner of the, and the period of which he has already invested would be considered. So, for example, A transfers shares to wife B. He bought the share of 1/1/2010. The cost was 6,000. Though he transferred the value to B, when B sells the shares as on today, the value of A date 1/1/2000 and the value would be considered for the purpose of computation. So there won't be any provision and it would be added to the income of A, not B, though it has been transferred to B. So is with the B is a minor. So it would be entitled in the end of the person who transferred the shares. After death of mutual fund, suppose some person dies on 1/1/2020. From the date, whatever mutual fund would be there, it would be transferred in the case of a beneficiary of a bequest property. And there would be a closed scheme on that day, close of the shares or PMS. There would be exact segregation for that period, 1/1/2000 for the purpose, suppose 1/1/2020. If I have a PMS and whatever gain which I have made, it would be bifurcated, cost would be bifurcated, core period. Suppose 1/1/2020, so 9 months before, 3 months after. So if before the person who died, in the case of a death person, there would be, and the person who is the beneficiary, the proportionate would be made and the valuation would be considered on the basis of that. The period of previous owner and cost of the previous owner, both will be considered. In case of gift, in case of irrevocable trust, in case of will, this period and cost of the previous owner will be considered for the purpose. We have considered gift to relative and non-relative. We have taken an example. Gift of share to relative is exempt from the tax in the hands of the beneficiary. Gift to non-relative will be taxable in the hands of recipient under section 56. The benefit of indexation costs will not be available for competition gain on transfer of bond, debenture, and specified spare in unit. Bond will not be entitled for indexation. Debenture will not be entitled for indexation. They have to consider quiet value. Here I have taken an example of demerger. Suppose I have a share of Reliance of 500, which I bought it for 10 rupees. So here I would look at like this, 550 shares. Okay, here 500 shares, but let me consider as 550 shares, 10 rupees, 5,500. My cost of acquisition is 50 lakh. Out of that, 550, they have demerged the Reliance Jio 100 at a cost per share value is 500. So 500 would be that. Are you getting it? I have got Reliance of 550, 10 rupees, 5,500. My cost of acquisition is 5,50,000. Out of that, Reliance has been demerged, and I have been given 50 shares of Reliance. In lieu of 50 shares, I have been given 100 shares of Reliance Jio. The value which was there at 10, here it would be considered as 5. So 550 means I've got only 500. Now my 50 shares would go out. So for the purpose of calculation, new cost of acquisition, RIL would be 5 lakh, Reliance Jio 50 lakh at the proportionate on the basis of above example. But there would be one correction. RIL Jio 500 would be considered as 550. Out of 550, have been Reliance share 50 shares would be converted into 100 share of RIL Jio, and the value would be now new value after demerger. Reliance would be 5 lakh 500 shares and Reliance Jio 100 shares. I got 50 shares in lieu of 50 shares. I got a Reliance Jio 100 share. Goodwill, if purchased and by payment of money, a consideration, it will be considered as intangible asset, liable for, eligible for depreciation at 25% under the intangible asset. For 44 FO transaction, here I've already talked once, but I'm talking it as, again. If my turnover is 1 crore, okay, and my income is below 8%, and my threshold, my taxable income is less than threshold, then in any case, no audit is required. Again, my turnover is 2 crore, income below 8 lakh, but income below 8 lakh, but below threshold limit, no audit is required. Below 8%, above taxable limit, I need to do audit. Suppose 2 crore is my turnover and my profit is 4 lakh, then I have to get it audit. And on through FNO transaction or intraday transaction, I have to do audit and give the report. If my income is above 8 lakh, in more than 5 crore, audit is required. My FNO transaction is below taxable limit of 5 crore, audit limit of 5 crore, and above 8 lakh, I don't need to do audit, but I have to show actual profit. Are you getting? There are 4 scenarios I've considered what all at the same time in these slides. Can a CA in practice transact in FNO? No. FNO in business, the CA in practice cannot do any business. Can a person who is working, as an employee in PSU transact in FNO? No. If the rule of PSU says that you are not entitled to business, then you cannot do set transaction in FNO and intraday transaction. Can a CA who is Karta of HUF transact in FNO? As CA is not allowed to do business, as he being a Karta of HUF, he also not entitled to do business. And so he cannot trade in share on behalf of HUF. Can a Karta can be made other than CA? Nowadays, Karta can be ladies also, women, female gender also. You can appoint somebody who is senior or junior. You can appoint them as a Karta and you can allow them to do the business. Suppose I have got a Ambala Sarabi shares which is not sellable now. Would it be considered, can I sell it shares to my wife or other person and make it a capital loss. No, it is not a good advice. It would be considered as a dead loss because it is not tradable asset. As section 50C was there, in the same parallels, 50C is drawn. What is for transfer of shares other than quoted shares? Those who are not listed shares. When you transfer these shares, you have to make a fair valuation on the basis of rule 1 UAA, and you have to do it is on the date on which the transaction sale is made or transfer is made. Okay, and it has to be at a fair market value on the date of the sale of shares. If the consideration is less than the fair market value, the difference would be added to A 56,110 as a gift. What is the value of how the cost is, how the valuation need to be? All asset, less IT paid, less deferrable expenditure. This all asset except jewelry and other artwork, which should be valued by valuer. The second property, what all asset other than jewelry, immovable property and shares. All assets should be valued on the basis of market value or cost, whichever is higher. Oh, no, whatever it may be, not higher. Fair marketing of shares, the same would be applied to, suppose I have got a company, I've got I've got an unquoted share of A. Which unquoted share? I have got a B unquoted share, so I have to value B's value also for the purpose of consideration A valuation. Immovable property will be valued at stamp value. Book value, liability, whatever I am liable to pay as per the valuation, I have to deduct from the total asset side minus liability side. Then comes net consideration. That should be divided by number of shares which I have it. That would come to a value. Number of shares multiplied by the price per share would come to the valuation of shares. The furthermore section, fair market value of shares shall be deemed to be the value. 1 second. Fair market value shall be deemed to be value of consideration under section 50D, where the considered receipt or accruing as a result of transfer of a capital asset is not ascertainable or cannot be determined, then the fair market of the said asset on the date of transfer shall be deemed to be the full value of consideration. Suppose I sold a set suppose A transfer a shares to B and the value is not determined, then for the purpose of valuation, fair market value, one you will be entitled for, and valuation should be made and consideration should be considered on the basis of 50D. Here I have taken an example for the purpose calculation of capital gain. Here there are 3 columns. Okay. Here there is one RIL listed, and MIP unlisted. I am going by row. Okay. I have got a RIL listed share, MIP unlisted share. What would be the capital deemed income in the hands of there is a column number 3 relative, column number A non-relative, column number B non-relative. So I have considered 3 column. 56 to 10 in the case of relative, in the case of A, in the case of B. MIP in the case of relative, this purple color would allow you to know in whose hand it would be answered. Date of acquisition for the purpose of reliance and date of acquisition for the purpose of MIC. Consideration in the case in the hands of a relative, in the hands of A, in the hands of B. This I have taken into this column. Now I am giving an example. I sold my Reliance listed shares at a free to my relative, say nil. So my cost in my books of account, in the books of me, there won't be any there won't be any 56 to 10 will not be applicable. There won't be any deemed gift. And for the purpose of 56, for the purpose of his sale by my relative, when he sells the share, the date would be 1198 10 lakh, which I have it, which I transfer. So one is I, one is relative, one is A, one is B. So in the case of relative, for the purpose of consideration, when he sells the shares, date of acquisition 1/1/198, and his cost would be 10 lakh. The same way consideration in my case would be considered as nil. So again, column number 3, where I've said nothing, one is A. Now I'm again going to sell of by me to MIP unlisted shares. My at a cost of 6 lakh. I sold to my relative at 3 lakh. Okay. And for as is my relative, he is not entitled to any 56 to 10 would be applicable. So 3 lakh will not be his taxable income. For the purpose of calculation of computation, when he sells the shares on 1/1, his cost would be date of acquisition 1198 and 6 lakh. For my consideration, it would be 6 lakhs because I have not sold at a nil price. So in my books of account, it be considered as 6 lakh and I am liable for tax. If I sell, are you clear? MIP unlisted, fair market value 6 lakhs, and I sold it for 3 lakh. So so 56 to 10 the gift is not considered. For the pace of cost of considered acquisition, it would be considered as 6 lakhs in the hand of my relative, and for my sale it would be considered as 6 lakh. As I have not done it at force value. Suppose I have bifurcated 500 shares. Okay, one is 3 lakh and one is 3 lakh. So now I have made two parts of my 6 lakh shares. One is 3 lakh and one is share. 3 lakh I without consideration, 3 lakh without consideration. In the case of second, there will be 3 lakh. For 3 lakh, I sold it for 3 lakh, and my consideration would be 3 lakh. For another of 3 lakh, I don't have to pay any tax. So this would be considered as tax planning for MIP unlisted shares. Clear? Now I'm going into another part, another sale of Reliance shares in the case of my relative. Here I sold at 9,80,000. The rule says that if I sold it for less than 20% to less than 50%, 50,000, 50 rupees, less than 50K, the sales consideration would be considered as no gift would be considered in the hands of A for RIL, and for his valuation it would be considered as 9,80,000. Consideration in my case is 9,80,000, not 10 lakh. But if it is less than unlisted shares, 5,80,000, 5,80,000 in the cost of acquisition, RIL, my valuation will be 5 lakh. Now we go to B. I sold RIL at 10 lakh. Fair market value for RIL, I am selling it to B is 10 lakh. In the case of column B, it is 2 lakh. So 10 lakh minus 2 lakh. In the case of RIL 56 to 10, B has to pay tax on 8 lakh. For the purpose of reckoning the calculation when he sells the shares, is the date would be 28/11/20, and 10 lakh would be the cost price. For the purpose of my consideration in my books of account, RIL consideration would be 10 lakh. So clear about transaction qua RIL to B. Suppose MIP unlisted 6 lakh, I sold it for 2 lakh 50,000. So difference between 2 lakh 50,000, 3 lakh 50,000, I have to pay tax. For the purpose of calculation of consideration, when he sells there, it would be 6 lakhs and 6 lakh would be my consideration. So here I have taken following points. If the difference is between 50K in the consideration, there won't be any tax qua listed or unlisted shares. And if I give a gift to my relative, the difference, the gift tax will not be 56 to 10 will not be applicable. But for consideration, if it is taken, I have to consider my value in my books of account would be a full value. So are you getting, and in case of relative, I got it in the case of this thing. So these are the 3 points are clear here. Section 242A. Section 242A. Here, short-term capital asset under section 242E. Assets held by an SSE for not more than 36 months immediately preceding the date of its transfer. So less than 36 months is a word here it is used. Suppose, let me give an example of a later stage, then it will be very clear what is exactly 36 months and more than 36 months. With effect from 1st April 2014, any listed share in recognized exchange. Suppose I have bought a Reliance on 1/1/2010, okay, and I sell it on 31st December 2010. I would be liable for short-term gain. So if it is first April 1/1/2020 लेना पड़ा 1/1/2019 was January 2019. Why I have to correct myself? Because this law is this rule has come into effect from 1st April 2015. So 1/1/2000 will not be applicable, but I'm talking about 1/1/2000. 1st January 2018, I bought a share of Reliance, and if I sold it before 31st December 2019, it would be considered as short term under section 242A. If I sold it on 1st January, it would be considered as long term capital gain. A security other than a recognized, these are the this is applicable to Reliance. Reliance is equal to security other than listed in a recognized stock exchange. Unit Trust of India, unit of an equity oriented fund. Equity oriented fund is equal to where the fund balance were more than 50% of equity. Quoted or unquoted zero coupon bond. Zero coupon bond would be considered as short term gain if it is more than if it is sold more than 24 months, more than 12 months. Short-term capital asset has been defined, is inserted in new subclause explanation 1 stating that period for which preference shares were held shall be included in computing the period of holding resulting from equity shares. Suppose I bought an equity share on a preference share on 1/1/2020. It has been converted into equity on 30th June 2020. I sold on 1st January 2021. As it is more than 12 months, the period for the purpose of converting into equity, preference and equity, that period will be considered for the purpose of reckoning the period of short term and long term. With effect from Finance Act 2018, with effect from Assessment 2019-20, inserted new clause explanation 1BA in explanation 1 into bracket 1 to section 248 stating that in case of inventory is converted into capital asset, the period of holding shall be computed from the date of conversion of such asset. Let me give you an example. On 1st March 2019, I have converted my Reliance is from investment into inventory, and then I sold it. The period holding shall be computed from the date of conversion of such inventory. Now, it is like the stating that inventory is converted into capital asset. Until today, it was on the 1st April 2019. My 100 crore Reliance was as an inventory. I have converted into capital asset. I sold it after 2 years for the purpose of computation of this long-term gain. My date from 1st January to 1st April 2019 would be considered, and there would be a period of 2 years would be required under this section. So when I convert capital, when inventory into capital asset, the date on which I converted would be the period and the value would be converted for this. Capital gains are generally charged to tax in the year in which transfer took place, with the exception that F45 conversion of capital into stock in trade in the year of actual sales. When I converted my capital asset into stock, okay, the year in which actual sales tax would be the year in which capital gain tax would be payable under section 45(2)(b). What is the period for the purpose of computation of long-term gain? Minimum period of 12 months I should have of Reliance. Unit Trust of India more than 12 months. UTI Unit 64 is the standard scheme for the purpose of any equity oriented scheme. I filed it for more than 12 months. It would be considered as a long term. Unlisted share, the period is not 12 months but 24 months. Land or building, from 1st April 2018, it would be 24 months. Unit of a mutual fund specified under section 1023D, 36 months. Any other capital asset, 36 months. Now I am talking about taxation of mutual fund. I here give you a period. I here explain you the rate, short term or long term. Any mutual fund which is equity based mutual fund, if I hold it for less than 12 months, it would be short term. Exactly after 1 year, 2020. After 31st December 2020, if I sold it, I sold it on 1/1/2021, it would be more than 12 months. It would be long term. If I sold it before 31st December 2020, it would be a short term. Equity fund, 12 months, less than 12 months, more than 12 months. Balance fund, less than 12 months, more than 21. Balance fund means more than 65%. Debt fund, where my folio is mostly considered of debt fund, which is not an equity fund, less than 36 months and more than 36 months. What would be the rate? In case of equity mutual fund, less than 1 year, I have to pay 15% short-term capital gain. If it is more than 1 year, more than 12 months, 10% on long-term capital gain without indexation in excess of rupees 1 lakh. Balanced mutual fund, which is a predominantly balanced fund, are the equity oriented hybrid fund that invest at least 65% of their equity. They would be because of 15%, 10% on long-term capital in excess of is 1 lakh. Debt fund, I have to pay as per tax slab. So it would be considered as my income from other sources, and it would be a short-term gain. And in case of debt fund, if it is more than 3 years, 20% after indexation. Clear for equity for all mutual fund, this slide would be okay. Computation of long-term gain on shares of both equity and preference, listed or unlisted equity and debentures. If it is not covered by STT, so these are the assets which I covered, which are not covered under section 112A, 111A. Long-term, without indexation, with indexation. So my asset is more than 12 months. Listed security other than those covered under section 112A with effect from 1920. So what does it mean? That I have got a Reliance of 100 shares and I don't sell it through stock exchange. I sell it to my friend, In that case, it is not covered under 112A, and I have to pay tax with without indexation at 10%, with indexation at 20%. Clear? Yes, no? Reliance, though I bought it from STT by paying STT, but I sold it to my friend. So without, not through success, but through demat slip, without indexation 10%, with indexation this percent. Unit of mutual fund specified in section 23 during the period beginning for the I am not considered. Unit not covered on above. I have sold my mutual fund without going through this. I sold to my friend, not paying STT. Same rule, without indexation 20%. Unlisted equity shares. Non-resident, I'm covering the next slide. Unlisted shares, I'm selling equity shares. More than 24 months with no indexation would be available, not available, only with indexation 20%. Preference share, not listed 10%, 20% with without indexation. Unlisted preference share. Listed preference 10, 20, unlisted always at 20. Zero coupon bond. If I sold without paying STT, 10% with indexation not available. So zero coupon bond, whether I sold it through stock exchange or non-stock exchange would remain the same. Unlisted debentures, if I bought it, I would be entitled for indexation, and after that I will be entitled for 20%. So these are the transaction where no STT is paid. Now we are coming into transaction. Section 11A takes on shorter comparison. STCG on transfer of equity share in a company where sale of shares says STC is payable or unit of an equity oriented fund with effect from 1st April 2015 of a unit of a business trust. Eligible for tax at the rate of 50% provided it satisfies the other conditions specified in the said section. The, the above provision shall not apply if units, I am not considering that. That is not. So if STT is paid both at the time of buying and selling, the 15%, if it is less than 12 months, I would be entitled for a discounted, if otherwise it will be added to my income at the appropriate rate which I have to pay. If it is 118 transaction, both the buying and selling I paid in STT, then 15% rate would be available. Here I give you an example of how swapping happens regarding STT. Suppose I have made I'm an individual. I have a short-term gain under section as per 111A, 6,50,000. My other income is only 1 lakh. So my total income is rupees 6,50,000. As my threshold is 2,50,000. I would be swapping 2,50,000 minus 1 lakh. 1,50,000 would be available swapping. So my taxable gain would be 6,50,000 minus 1,50,000. I was 8 lakh, 5 lakh would be my taxable STCG, and 87A deduction would also be available. Is I'm a senior citizen above 60, I'd be entitled for swapping of ways 2 lakh, as my threshold limit would increase to 3 lakh. If I'm a very senior citizen above 80, so above 80 I don't have to pay tax up to rupees 5 lakh. My short-term gain is 6,50,000. Other income is 1 lakh. Okay. So for swapping, how much I would be available? So now my 6,50,000, only 1 lakh is my income. So for swapping, I would be entitled for 4 lakh. 4 lakh minus 6,50,000. So I have to pay tax on 2,50,000 as a short-term capital. Here also I will be entitled for 87(1)(a). So in anyone's case, you can use For the purpose of short-term gain, you can use your senior citizen, very senior citizen 87A to do a tax. And the only thing which you need to do is to have a senior citizen account, demat account, and you have to pay money from that account and you can save your tax. But you cannot do in the case of minor as well as your spouse. Now I am going into section 112A, tax on LTCG. Long-term capital gain arising on transfer of equity of an equity-oriented fund if STT is paid at an acquisition and transfer of equity. However, the central government, both at the time of purchase, the central government may by notification specify certain STT may not be allowed though you're not paid sales. They have given few examples. You bought it as a sweat equity or you have purchased through right share. There are certain specific circumstances in which even though you are not paid at the time of buying, selling, still it would be allowable at the rate of concessional treatment under section 12A, and tax would not be level up to rupees exceeding rupees 1 lakh. This would be available for mutual fund and equity oriented fund. What is the distinction between 111 and 12A? 87A rebate is not available in case of 112A. Here the first proviso and second proviso to section 48, the indexation benefit in respect of cost of the cost of improvement while company is withdrawn. Capital gain in case of a foreign currency, a non-resident will not be the new scheme for competitive LTCG has come into effect. This is called grandfathering concept. Here what will be considered actual cost of acquisition. Here there will be one for 2000 value or actual consideration, whichever is lower, and the second one fair market value consideration, grandfathering, whichever is higher, and on the basis of that your calculation is made. So again I am repeating, for the purpose of calculation there are two costs one needs to consider. One is cost of acquisition before 1 for 2001 or cost of acquisition is the fair market value 1 for 2001, whichever is higher will be considered. If you consider after 1 for 2000, the first provision will not be considered. And what is my cost of acquisition in fair market value grandfathering concept on 31st January 2018, that is first day. And here what would be the value of 31st January 2018? The maximum price either in BSE or NSE would be considered highest of either of these two. And if on that day there won't be any transaction, the previous day, if it is not on the previous day, meaning thereby latest date on which the transaction took place, either at BSE or NSE, the highest value of the latest date would be considered. So this is a fair market value less consideration whichever is higher. Here I am considering the three scenario. My actual cost of acquisition is say 1000. Fair market value as on 1st January is 3000. I sold it for 4000 rupees. So what has happened? Lower of these two, 3000. Cost of acquisition is 3000. So there won't be any tax on that. Cost of acquisition will be 0. Okay, here. Suppose second scenario, cost of acquisition 1000, lower 3000, fourth cost of acquisition 3000, 1000 would be taxable. Now I am into cost of acquisition is 1000, fair market value 3500, still considered 3000, so there won't be any capital gain in this case. Scenario number 2. In scenario number 1, lower of these two, cost of acquisition I have 1 or 2, 3000, and I have to pay tax on 1000 in scenario number 1. In scenario number 3, I have acquired shares at 100 rupees. Fair market value on that day on the grandfathering was 300. But today my value is 70. 70 minus 100. So there would be 30 rupees loss which I will be entitled. In scenario number 1, I have to pay tax on 1000 rupees. Now this is for the purpose of considering how 1 lakh would be benefit would be available. My actual cost is 2 lakh. My sale value is 5 lakh. So 3 lakh is gain, but fair market value as on 31st March 2000 parenting day is 4 lakh. So 54 AC considers value as 4 lakh, as 4 lakh, 4 lakh is there. 4 lakh minus 1 lakh is 1 lakh. 1 lakh minus 4 lakh as per 52 AC. 4 lakh, 3 lakh is my gain. 4 lakh minus 1 lakh is gain. But 1 lakh 112. So in the first column, in the first row, I don't have to pay tax. Now coming to column number, row number 2, my cost is 3 lakh. My sales consideration in the row 2 is 7 lakh. So I have made a 7 gain lakh. Fair market value and on the date is 5 lakh. 5 lakh minus 5 lakh, 1 lakh. 1 lakh will not be 1 lakh. I have to pay tax on rupees 1 lakh. Long term capital gain. My actual value cost is 2 lakh. 4 lakh is my sales consideration, 2 lakh is my gain. Fair market value on 31st March is 5 lakh. So 4 lakh is my consideration. So my cost would be 0 in column number 3. In column number 4, my actual cost is 3 lakh. Sales consideration 2 lakh. So I made a loss of is 1 lakh. For my fair market value on 31st grandfathering concept is 4 lakh. 55 to AC, it will come to 3 lakh. 3 lakh minus 2 lakh is equal to 1 lakh. So column number 2 minus column number 5 would be considered for the purpose of competition of this. Okay, 5 lakh minus 4 lakh minus 1 lakh is equal to 0. 5 lakh minus 2, column number 2 minus 2 is equal to less 1 lakh. 4 lakh 0. 2 lakh minus 3 lakh 1 lakh is the loss. So this is how all this calculation is made. These I already discussed here. Proviso 1 to section 40. Section 40 explains that the method of calculation of capital gain on transfer of shares or debentures of a private of an Indian company in case of non-resident, the same shall be computed by conversion of sale consideration, cost of acquisition, and transfer of expenses into the same foreign currency in which it was utilized for the purchase of shares and debentures. The capital gains so arrived are converted back into Indian rupee as per the rate specified below. I have given the competition sheet later on this. So we may work on that also. Sales consideration, TTT on the date of sales, date of transfer, cost of average exchange, the date on purchase, expenditure on sales, the expenditure date on which the transfer took place, either expenditure rate either on purchase or sales. Capital gain would be considered buying rate on the date of transfer. Clear, the date on which I sold it would be considered. Here is an example. I bought a share of rupees 20 lakh at the rate of 50. I have not specified date intentionally because for the purpose of getting rate, I have considered the date. So I bought the share of $40,000. I sold it at 80 lakh rupees on next date. At that date, the rate of TT rate was 75 for dollar. So I will be entitled for 1 lakh 60, 1 million. So my net gain is 66,667. So 66,607 multiplied the date on which I sell the shares comes to rupees 5 lakh. Here there won't be no indexation. There won't be any other benefit. Are you clear? This is a competition for the purpose of non-resident. For non-resident would not be entitled to indexation, but they would be entitled their cost of acquisition, sales consideration improvement would be considered on the date on which you have made the payment into convertible foreign exchange, and you would be entitled for this. Would be entitled. This would be available for what type of company? Private, what are listed shares, debentures, whatever may be, public or private. No indexation would be available in this case. This is especially for indexation. Indexation in case of capital asset, long-term capital asset except specified equity share and equity oriented for the cost of acquisition will be entitled for cost inflation shares. Any unlisted shares would be entitled for this scheme. For example, if cost of acquisition in the 2004 is 50,000 and it is indexed for 2000 50,000 plus index year divided by this, you'd be there from 1/4 2018. The base year is shifted to from 81 to 2001. So now base year is being shifted from 1981 to 2001. So it will be very easy for you to get the valuation, as well as valuation would be higher. So indexation value would change. Indexation parameter would change, but a value would also increase. Here now I am going into a very different presentation where I've gone into value on shares held in case of a liquidation. The date on which liquidation would happen, the period will not be reckoned for the purpose of considering long-term or short-term or indexation. When capital is become the property of the SEC in circumstances mentioned in section 49(1), if I got a share in partition of HUF, if I got it from gift, if I got for will, if I got it through irrevocable trust, the period of the previous year would also will be covered for the purpose of calculation under section 242A. 242A decides the period for which you held the shares. This would be considered whether it is short term or long term. Conversion or treatment of inventory as capital asset refer to section 2A. Conversion of treatment of inventory into capital asset. The date on which I converted inventory into capital asset, the period prior to inventory date will not be considered for the purpose of ownership. Shares acquired or sold in the scheme of amalgamation includes the period of amalgamating company. A right shares issue, I am talking about serial number 5, begins from the date on which the allotment is made. Column number 6, right to subscribe any shares begins from the date on which right is offered to a person. Bonus shares and security, the date on which I have been made an allotment of bonus would be the date on which the period would be considered. Shares in Indian company acquired as a consideration of demerger. The demerger company's share, the original company share period would also be considered for the purpose of reckoning the period. Section 242A recognized stock exchange, I don't talk into that because it's a very rare case. Equity acquired as a result of circumstances mentioned in 1H referring section 47(13) into the period for which person was a member of exchange immediately before the demonetization. Now I am into column 11, serial number 11, 242(1)HB, sweat equity or security transfer free of cost at a concessional rate by an employer to employee begins from the date of allotment of such shares, which I've already covered the cost, but here I've covered the post. I'm considering the date. Section 242A(1)HC, unit of a business trust, I am not going into that. Section 242A(1)HD, unit in consolidating scheme of mutual fund as referred in section 47, 15, 18. This I have covered. The unit 64 converted into unit 2000. The period of unit 64 would also be considered for the purpose of, in the case of consolidation of the scheme. When you are acquiring GDR into your Indian currency, this thing, the date on which redemption is made, that date would be considered for the purpose of, from that date, the period for the purpose of long-term or short-term gain would be considered. Convertible or preference share, I consider that equity, the original shares would be considered for the purpose of competition, which I have already discussed in this. I am not considered 16. Now, as in these slides, I'm talking about cost of acquisition of a share. Shares of a recognized stock exchange. We have considered here one for 2001 value or cost of acquisition, whichever is higher, and fair market value and consideration whichever is lower. And on the basis of that, we will consider 52, 55 to AB. Amalgamation under section 47(7). Cost of acquisition, cost of shares in the amalgam. The original company share would be the price of which you have paid would be considered here. On conversion of bonds, debenture stock, deposit certificate into shares or debentures, or conversion of bond referred to section 115 AC into bracket 1A, 49(2) into bracket 2A. Cost of acquisition, that part of cost of bond, debenture, etc. in relation to which such asset is acquired by the SEC. Stock option 4922A, 49 cost in case of specified security tax, the purchase value plus the price paid by you would be considered as the value for the cost of acquisition for the purpose of 492A. Conversion of company into LLP. Suppose section 49 to AAA on conversion of company into LLP. The cost of acquisition of the capital asset being the right of the partner will be the cost of acquisition of shares or shares in the company immediately before its conversion. Suppose I have been entitled for LLP 20%. The 20% is my LLP's right. So what would be the cost of my LLP right? The cost which I paid for the purpose of getting my right into the company. SWAT equity we have already covered. GDR, the cost of acquisition we have covered. I'm not going into too much detail. You will be able to understand from this. So I'm skipping cost of acquisition, all of each. Cost of acquisition I am missing. I've already deliberated in detail. So this slide you have to go through and read it. I'm not going to take into that. Now section 45. First column is type of asset, in the hands to be assessed, and year and the consideration. This is very important slide. Let me go in short in here. Here there are rows and columns. First is the section, particulars of transfer, the type of asset, capital gain accessible in the hands of, year in which it is chargeable, the amount of which it is chargeable. So here, first I'm not taking 45(1), 45(2) I'm taking. Conversion of capital asset into stock in trade. So if I convert my investment into stock in trade, I am the owner of such asset. I converted it. The year in which sale or transfer took place is a stock in trade takes place. Suppose in the fair market of the date of conversion. Here, let me give you an example. On 1/1/2019, I have converted my capital asset investment into stock in trade at say Reliance at rupees 50 lakh. I am the owner of shares. It would be liable for tax in my hand. Year in which I sold it, say in 2022, my cost was 50 lakh. I sold it at 80. In the year, say I sold it on 1/1/2022. So year in which I sold for 80 lakhs. So the date of valuation was the year in which I transferred was 50 lakhs. So 30 lakh would be added on the date. On that date would be my short term, my business profit. The date on which I've converted, for that it would be the year in which it would be added, the year fair market value, date of conversion. So on the date of conversion, my conversion was 1/1/2019. On that date, it would be considered as fair market value and it would be added to my income as long-term capital gain tax. So there would be two tax qua that income. Transfer of security made by depository. I'm not taken into consideration. If a transfer of capital asset by a person to a firm, AOP, BOI, as his capital contribution or otherwise. So I have converted my 50 lakh rupee shares A in the name of, suppose I am A. I am transferring my Reliance shares in ABC company. My book, my Reliance today value is 50 lakh. The partner or the member so transferring. So it will be liable in my hand. The year in which transfer, say I have transferred in 1/1/2020. So for financial year 1920, 1/1/2000, it will be liable. What will be the value? Though the market value is 50 lakh, I have converted, I have introduced as a capital of 40 lakh. 40 lakh would be my net consideration. Transfer of capital asset by a person to a firm. Are you clear? I give you an example here. Transfer of capital asset by way of a distribution thereon, dissolution of a firm or AOP or BOI or otherwise. Suppose now I am an ABC. ABC is a partnership firm. He distribute to A on the dissolution, on the distribution of shares on dissolution. The fair market value on the date of which the dissolution made is 80 lakh. So the firm would be liable to tax at a consideration the date on which the distribution is made. Date is the date on which distribution made, value is the value on the date of distribution. And in whose hand? It will be hand of ABC partnership firm. Transfer of real estate, I don't want to take it here. Certain transaction not regarded as a transfer. Partition, partial partition is derecognized, but if I transfer my HUF shares to my member without a full partition, it would be added to the income of a HUF only. Okay, so transaction is not recognized. If I give a gift, will or irrevocable trust, then it will not be regarded as transfer for the purpose of computation of period and the value. The value of a previous year would be considered. I have transferred some assets from holding company to a subsidiary company, and subsidiary company is an Indian company where 3/4 of the same, then this will not be considered as transfer and there won't be any capital gain. Same is with the scheme of wholly owned subsidiary company, owned subsidiary to a holding company. Condition, holding company should be an Indian company and 3/4 of the same, the value, this will not be considered as transfer and there won't be any capital gain. In the scheme of amalgamation, by amalgamating to an amalgamated company, those company which is disappeared to a company which is appeared. Indian company is between two foreign company which we are taking. Banking company we are not taking. Foreign company, demerged company, Reliance company to a Reliance Jio. If it is wholly owned subsidiary. Being shares of Indian company, we don't go into detail here. These are too tricky conversation. You can read it. I don't want to do it here. 54, 54 BC, 54D, 54 EC. I would consider 50D, 54A is applicable to residential house property only. 54B is land, 54D is land or building, 54 is available for land or building or both. This calculation we are not going to this. Thank you very much. This is a lengthy presentation. Any question on any subject, you can email me nitinpathak@gmail.com. My WhatsApp number is there. My blog address is there. Anyone who wants to do Isaca, who wants to get material, whatever support, who wants to do CISA, CSAM, CGST, Isaca course, certain material which is available on this, we are ready to support them. Our main aim is to promote Isaca chapter of Ahmedabad. Thank you very much. Thank you very much, Nitin Pathak. Thank you very much.